Hello everyone, I'm Conray. Welcome back to the channel. So in today's episode, we'll be delving into many different topics. So first of all, it will be the Citrini report, the one that actually crashed the markets. Second of all is Netflix and my Netflix thesis and why I think it's an interesting opportunity today, though I'm not actively adding. Third of all, it's FICO stock. This stock has been hammered over the recent days and I've had a lot of messages asking me if FICO is attractive today. So I'll be delving more into that one as well. So let's talk about this Citrini report over here. This report was actually the one that crashed the markets. So if you didn't know what happened, this guy, he released a report. He released some sort of a research report, although it's more of a narrative. And then he talked about how the markets will implode because of AI, how an abundance of intelligence will cause cost of labor to drop over time, which will lead to lower income for everyone, leading to basically a self-reinforcing cycle, a self-reinforcing recession. So I actually wrote a piece on this, just highlighting some of the main points as well as some points that were specific to the companies that I owned, which is Visa as well as Mastercard. So summarizing Citrini's points, he mentioned that AI becomes so intelligent to the point where it replaces white-collar labor. So it becomes a self-reinforcing loop of wage compression, weaker consumption, and financial instability. The end product is, of course, an economic crisis. So he mentioned that this supposed economic crisis will come in 2028 and with the stock market peaking out in 2026, which is this year. So there are parallels with the dot-com crisis. So there is always an oversupply of something. So if you look at the dot-com crisis, there was an oversupply of both infrastructure as well as capital. There was too much capital in the markets. And then after that, it led to some form of a bubble as well as a margin collapse of the financial markets. In today's world, he's arguing that there is an abundance of both intelligence. That means too many things are getting too smart too fast. And second of all, he is also arguing that there is excess infrastructure, meaning to say there's a lot of data center build out and they're building this out because now the demand is matching the supply. But what if one day that demand no longer holds? So in AI today, Citrini argues that we have an oversupply of both intelligence as well as infrastructure. So without getting too philosophical, when you mistake a well-explained story for reality, it becomes a fallacy. So in my opinion, I think the research report was more of like a story. It's a story that brushed over many different elements of our human lives. So for example, he talked about friction and how friction will disappear. That was one of his core arguments of his entire piece here. And my core argument here will lie on the very fact that humans have always found a way towards survival. So if you look in the past history, humans have always found a way to survive. So we had diseases, we had wars, we had everything, and we still survived out of it. So similarly, I don't think the AI crisis, if it ever comes, will be one that is terminal for humans. We will adapt, and that's my core argument. And while the extent of the crash may vary depending on how severe the problem is, if it ever comes, I don't think predicting the crash without any tangible information is something that is intellectually provoking here. So I won't be discussing that one. He talked about a few of my holdings, Visa as well as Mastercard and DoorDash as well, and American Express. I'll be delving over Visa as well as Mastercard, so I added into both of the positions when they were down around 7% 2 days ago. And on Visa and Mastercard, one of his core arguments that he raised was that agents will basically help to remove the friction required whenever you're trying to pay for something. So for example, you can have agents buying things for you. You can have agents knowing exactly what you want to buy. You can have crypto networks that will bypass the traditional railway system so that your merchants save on the interchange fee. And while this is possible, the problem here is accountability. Who is going to be accountable if the agents are the ones at fault? So we have insurance companies, we have credit rating companies, those are your stamps of approval. You have auditing companies similarly, and they've been around for years. The reasoning behind these industries, the reasoning behind the existence of all these industries is simply because humans are willing to pay a premium to reduce uncertainty or perceived uncertainty. So similarly, blaming Visa, Mastercard, your banks, your merchants, if something goes wrong is what the consumers want, and that is not something that agents can guarantee. And from a consumer standpoint, when you're trying to pay for something, of course I want friction. I want to make sure that if something is fraudulent, I can get it back. I want to make sure that I get my rewards from paying using the credit cards. I want to hold my cash for a longer period of time so that I earn interest on it. the entire argument of a crypto network bypassing this traditional railway system is beneficial to merchants. But on the consumer end, it is something that isn't really tangible. And besides that, Visa is not just a commoditized card network. They are a trust network, they are rule makers, and they're identity layers as well. So a possible argument here would be compressions of margins over time, limiting pricing power whenever there's presence of viable alternatives. The key here is to weigh whether or not Visa and Mastercard are actually susceptible to these margin pressures and whether or not they are able to mitigate this. In terms of crypto, both companies are actively pushing out their crypto network infrastructure, and with the trust that they have in the eyes of the consumer, it will easily be adopted as compared to the other crypto networks that are existing currently. Adding on to this, frictionless alternatives have existed even before the blockchain network. So you had A2A transfer networks, PayNow, Payla, overseas as well, you had Wero. The narrative here may be a valid case of margin compression, not complete replacement, which is what the researchers here were trying to subtly paint. So they mention of how Mastercard's entire business is going to become obsolete because there's no more friction. Your agents can pay for everything. Your agents can handle whatever preferences you have. But the problem here is that if your agents are the ones buying the things for you, like for example on Amazon you have Alexa, wouldn't it be the agents introducing more friction? I mean, at least for now, the agents are not exactly frictionless yet. So we should not mistake a story for reality. Steve Eisman, he was one of the big shots that bought your CDS, your credit default swaps in 2008. He is still long on the Mag 7 stocks, despite all the bearish takes that is being put online right now. This suggests that his positioning may be more nuanced than what the extreme bearish stories imply. I think for the latter, it's one that brushes over a lot of points, a lot of key points of human aspects. And for now, at least, it is not a viable story in my opinion. Next part, I'll be covering Netflix. So Netflix has seen some form of a rebound after the Warner Brothers Discovery deal was basically put on hold because Paramount are coming in with a new bid and then they're bidding higher than Netflix. In my opinion, I would hope for Netflix to not pay for the acquisition and to just take the 2.8 billion settlement fee. Historically, most acquisitions have not worked out in any company's favor. It is more common to have value destroying acquisitions as compared to value creating ones. So hopefully they don't sign it. But in the case of Netflix, I'll be releasing this investment thesis soon. It's on our newsletter. So it's the link in the description. It's similar to the news report that we read earlier. Feel free to check it out if you're interested. But there's a few different key points that I would like to raise for Netflix. So I believe I previously covered on Netflix, but there were a few points that I missed. And a lot of this are actually important. One of my main theses for Netflix today is on the ad tier division. So I feel the ad tier division is something that is underappreciated and will drive margins over time. So in terms of ad revenue today, the problem with Netflix is that their fill rate is extremely low and their ad inventory isn't exactly high as well. Fill rate means how much of the ad inventory is currently being filled. Ad inventory is how much ads is being allowed on the platform to run ads. So for example, in the case of YouTube, you have your banner ads, you have your video ads. When you pause a video, you have the side banner ads as well. All those are considered ad inventory. For Netflix today, they're still not actively pushing for ads in their platform because previously, before I think mid-2025, the company was reliant on Microsoft's entire ad service. So as a result, your advertisers, they didn't have the ability to optimize their ads. So what Netflix is currently doing today, they've started pivoting since around mid-2025, is they're actively building out their own ad tech suite. Besides having greater control over its data and optimization for advertisers, Netflix is also opening up their ad inventory to make it more accessible for advertisers. So previously they had a fill rate of around 40 to 45%. That was what management has said. But if you're to compare it to other companies like for example YouTube is at a fill rate of above 90%. So Netflix still has a long way to go. And what Netflix is currently doing today is they're opening up their ad inventory to demand-side platforms like for example the Trade Desk, Amazon, Google, allowing for greater fills. So Netflix is basically turning on the tap for their existing subscriber base today, those that are tied to the ad tiers. And Netflix is superior at inventory. Why? Because they prioritize premium content as compared to user-generated ones. And currently now, the ad tier is only offered to around 12 countries around the world. And what the company has always said is that they adopt this strategy of crawl, walk, run. So they're currently in the run phase in terms of the ads. So we're not seeing exponential growth yet. Once they transition into this run phase, where they push it out to the entire globe, where they push the ad option to the entire world, that is when we'll see exponential growth in terms of their ad revenue. And currently, just based off of the numbers, let me show you the sensitivity analysis. This is what they currently have today. So they have around 94 million ad users, and the fill rate is around 40%. Your ads per hour is around 5. So this is incredibly low. If you compare this to Google's YouTube is currently at around 25 ads per hour. And the forecasted CPM today is around $20. So that brings in around $1.5 billion of ad revenue for Netflix. And just for contrast, your cable TV, they have CPMs of upwards of $40 to $50 because they're considered premium content. Netflix is also considered premium content, and they currently have a CPM that is on par with user-generated content in YouTube. So I think there's a lot more room to grow in terms of their ad revenue. It will be a fill rate TCs whereby the company basically opens up its ad inventory to more advertisers. Because in the past, before they had their own ad tech, what they had to do was to phone advertisers, literally call them and ask them if they want to advertise on the Netflix platform. Currently, with the new demand-side platform, I expect this fill rate to grow substantially over time towards the YouTube's 90% sooner or later. So over here it says the greater ad fill premium content allowing for greater CPM, along with Netflix continued expansion of this ad offering will allow the company to spearhead and grow ahead. Management is planning for global ads push in late 2026. This is a smart move by management, which is what we said earlier, crawl, walk, run. We are currently in the phase of walk. Currently, the ad tier is providing a lower revenue per subscriber relative to the premium tier. The key here is to determine whether or not ads are accretive to your average revenue per member or dilutive to it. With the global rollout of ads, we can expect both growing subscriber count along with the optionality for substantially greater average revenue per user for the ad tier. Long-term, ads will be margin accretive business for Netflix, with every additional ad having minimal additional costs. While ad tier is still dilutive to their ARPM globally, we expect the gap to close, with ARPM already higher than Netflix standard plan in the US. So what this shows is that there is some form of success in terms of the ad tier, and I believe this is one of the TCs that is undercovered today that can drive Netflix towards incremental margins over time and sustain the revenue growth for longer than what the market thinks today. So for Netflix, I'll be releasing this newsletter soon. Hopefully they don't bid for this. And yeah, I expect the company to recover in terms of the stock price. I'm still currently waiting. It's a starter position for me to track the company. I'm not actively buying into the position yet, still waiting. And hopefully it gets to a more reasonable valuation. You'll see it in the Substack in terms of the fair value. I'll release it soon. Okay, so last part I'll be covering FICO stock. So FICO has been hit very hard recently. I've had a lot of people reaching out and asking if FICO is reasonable today, whether or not the stock is a buy today. So I'll be talking more about it. And this was actually an article that was released by VantageScore CEO. So he says that VantageScore predicts risk better than FICO. And the reason why the stock was down is because the leader of the FHFA, which is Bill Putte, he retweeted this article. So the stock fell by 5% yesterday. So over here it says, competition enables greater choice and better outcomes for markets. And that's why Congress passed and the President signed into law the bipartition of the 2018 Credit Score Competition Act. So lenders choose VantageScore not because it's an easier score, but because it uses more data and is better at predicting a consumer's credit risk. So he's basically saying over here that the Vantage 4.0 score is more predictive than your FICO Classic score. And that VantageScore was designed to improve mortgage default prediction using additional data, so on. And it's an opinion piece. It's by the VantageScore CEO. So obviously he's going to be a bit more biased towards VantageScore. As for whether or not FICO is at a reasonable valuation today, so let's talk about FICO as a stock in itself. FICO is currently trading at around 45 times earnings, and I've looked more deeply into the company and I have a better understanding of what exactly is going on in terms of the Vantage score today. So FICO this year is trying to push for something called your direct licensing. So what they're basically doing is they're trying to get mortgage lending companies to sign contracts with them and to primarily use FICO scores and to pay FICO directly instead of going through the credit bureaus. So that's some form of a transitional business model that the company is undergoing today. We'll see a huge revenue surge this year, but whether or not the revenue can sustain over time is another question in itself. So the reason behind this is because number one, the company is trying to bypass all the credit bureaus. So as we all know, the credit bureaus, they increase the price. And then as a result, your mortgage lenders, they have to pay more, which means your consumers have to pay more. In the case of FICO, they introduced this to basically bypass the increased prices from your credit bureaus so that they can keep the economics themselves. Second of all is that there is something called an LLPA grid. So an LLPA grid basically allows for the scores to be measured against the risk. So what I mean by that is the GSEs, which is Fannie Mae as well as Freddie Mac, they use this LLPA grid to tie a score from a specific model to an interest rate that they'll assign the mortgage to. And so in the case of this LLPA grid, currently only FICO Classic scores have this LLPA grid. So in the coming years, in the coming 1 year or so, I believe, a Vantage score will also have their own LLPA grid similar to FICO 10T. So the value proposition for Vantage score today is this. Vantage score is cheaper. The mortgage companies, they have a greater incentive to use Vantage score. If Vantage score is accepted by your government-sponsored enterprises and is able to prevent risk as much as your FICO score. And in the case of Vantage score today, there is almost no difference between Vantage score as well as FICO 10T based on industry users. So for FICO under the mortgage segment, you have the GSEs, which is Fannie Mae as well as Freddie Mac. They make up around 60% of mortgage volumes. And then you have your private securitization, which is around 40%. For FICO, I think this 60% is currently at risk with this new Vantage score. I know there's been claims that this Vantage score is no competition. I know Dev Kantasarya has also said in the past that Vantage score has long existed for a very long time and there's no adoption on that front. But last year, Vantage score was actually signed into legislation to be allowed for your GSEs. I think it's tangible that Vantage score takes away some market share from FICO. And currently at the 45 times price to earnings, I think the stock has probably a bit more to fall before it gets to a better valuation for me to want to add to my position. I currently hold around a 1% position in FICO. I'm not actively looking to add into it yet. We have to see how this one plays out. And I think the competition is tangible. It shouldn't be one that is ignored. Although the revenue for the firm this year will probably be great because of this direct licensing model that they're trying to push. They'll probably experience a 50% increase in terms of their mortgage revenue. I'll release a news article as well for FICO soon, and with the models, with the fair values and everything. So stay tuned for that one. I hope you guys have found this video useful, and yeah, I'll see you again.